One of our speakers, Professor Stiglitz, is delayed. His train was late coming into Penn Station. So while we wait on him to make his way to the building, we thought that we would go ahead and let the speakers introduce themselves.
Okay, so maybe I should start because I actually am the one who had the idea, so I'm the culprit for that. So my name is Christian Deseglise. As you can probably hear from my accent, I'm French. I studied at Columbia in 1988, graduated in 1990 at the School of International and Public Affairs, and I've been working in emerging markets, with emerging markets, living, breathing and living emerging markets for the last pretty much 20 years. Before being at Columbia University, I was at Sciences Po in Paris. I also taught in Colombia, the country, at the School of International, what was it called? I can't even remember what it was called, the Altos Estudios para el Desarrollo, so high development studies. In Bogota for a year and a half, I taught international affairs. After graduating from SIPA in 1990, I decided to go back to France and start working in France. I thought it was much more difficult, too difficult for me to work in Wall Street because, as you will see when you graduate from SIPA, you have to work a lot, very, very long hours in Wall Street or wherever you're going to be working. So I decided to work a little bit more quietly, I would say, in France. And did that for about 8 years, then moved to London, and I've been in New York for the last 8 years. I'm responsible for emerging markets, for HSBC Global Asset Management. We manage about $80+ billion in emerging market assets. I must say that it's much less than we used to manage a few months ago because the markets have not really been on an uptrend in the last few weeks. So our assets also have been dwindling. But it's been a phenomenal 10 years, especially the last 10 years, I would say, because the first 10 years you needed a lot of faith to believe in emerging markets and to think that someday they would start really emerging. I think the last 10 years have seen the phenomenal potential of emerging markets and the shift really in the center of gravity of the world economy from the G7 to the emerging markets. And I think that one of the characteristics really of the present crisis is probably to accelerate that shift towards emerging markets. So I think if there is a silver lining, and I'm sure we'll be discussing that in the next hour or so, but if there is a silver lining and if one has to see reasons for optimism in the current crisis, is probably because, in my view, it's accelerating that rebalancing of the world economy. So that's a very long introduction. I'll pass now to Richard here, who is going to introduce himself also.
Thank you, Christian. I see you're French. I heard you speaking Spanish, speak English, you probably speak other languages. I only speak English, so that way you know I'm American. Many of you, and I would also like to say, Christian, that I see many of my former students here. It's a pleasure to see you. And they work very hard in their way. And I think it will be no shock to them at all when they land on Wall Street or whatever passes for Wall Street when we send them off into the world. So I teach here, and I have been living and breathing the financial crisis for some time in my day job, which is managing a fund. We don't call it a hedge fund anymore, but it's sort of like one. And it invests in credit in Europe and Japan and other parts of the world. And so it's given me some insights into things which I'm looking forward to sharing today after Professor Stiglitz gets here. So I'll pass things over to Jose.
Okay, we're going to now to start the formal panel. Now that we have Professor Stiglitz with us, let me perhaps start with some questions, some very short term and some looking a bit forward. I mean, the first question is the following. Does the current recovery, I mean, that took place today, does it mean that somehow the government's finally got it right? That perhaps that the British initiative last week, which seems to be spreading as the solution, was the right one, and the recapitalization of banks with public money is probably the solution, together with some guarantees on debt. Well, of course, we all know that that is only the stopping the bankruptcies, which is only the very beginning of a solution, because in a sense, my second question is, even if somehow the institutions are going to avoid, or this series of bankruptcies is going to stop, do we have a really good chance that the credit squeeze will stop? That somehow we'll have a recovery of credit, which has to do with my third question, which is regarding the economic activity. I mean, we haven't started to see, in a sense, still the real effects of what happened. I mean, all the projections of economic growth have been downgraded by at least 1 percentage point, maybe up to 2 percentage points in the for the next year. Let's say for a year starting, let's say in this quarter. Now, just looking from the perspective of developing countries, the crisis in the past. It seems that after you have a huge crisis such as this, the credit system simply doesn't work as a. I mean, you essentially have effectively a credit squeeze of maybe 3 years. Some countries even more than that. So that simply trying to do this through monetary and credit stimulus will not work, and you have to have some other sort of solution to the real problems. Joe, we already introduced ourselves, and you need absolutely no introduction. So let me just give you the floor for.
Okay. Well, in the long run, we're going to recover. But as Kane said, in the long run, we're all dead. Every economic downturn comes to an end. But this is going to be the longest economic downturn since the Great Depression, I think. It may not, in some ways, be the deepest. There'll be some competition with the early 80s. But it all depends on how well managed it is. And we're off to a very bad start. And we have, unfortunately, even though there's an election, we have 2 more months of incompetence. So that doesn't leave me with a lot of optimism. And you said that the unemployment is only 6.1%. It was basically 4%. But there's a lot of disguised unemployment. The total unemployment rate, as it's sometimes called, is much higher. It's about 11%. That includes a very large number of people who are part-time jobs involuntarily. They would like to work full-time and they can't get jobs. So already the labor market is showing weakness. And I think the standard forecasts are now showing unemployment in the United States getting up to the high 7s, 7.8% or something like that. And that's if things go well. So I think we are clearly in for a serious downturn. Let me, you said the stock market has gone up today, and the thing about the stock market is that it goes up and it goes down. These are guys who are betting on, most of whom don't know very much about anything, and are betting on what other people are betting about what other people are betting, and they're trying to figure out that. So I don't put much stock in that. The more relevant variable is what's been happening to interest rates, the LIBOR, the other measures of tightness in the credit markets, and that wasn't eased today very significantly. And so my view is that it is actually, it's very good news that there's somebody like Gordon Brown in the UK who can figure out what to do. And actually, what we've been talking about what we should do for weeks. And he not only figured it out and implemented while we're still flailing around figuring out what to do. We say, well, we have several alternatives, and it is actually quite amazing. Just as an aside, because this is a school of public policy, the original proposal of Paulson, if I had been at the World Bank and somebody from a developing country had come forward with a proposal like that, we would yell and scream and say we would cut off all foreign aid, all lending, that this country is, that's the kind of corruption, lack of transparency. I don't know if you know, it was a 3-page bill giving the Secretary of Treasury authority to spend $700 billion without oversight or judicial review. And you either have to, it's either the kind of arrogance that got Wall Street into the problem and or stupidity. Because he said that we needed money right away and we need to do something right away, and anybody who had any political sensitivity knew that he wouldn't be able to get that through Congress. You would not have been able to get that through Congress if there had been an administration with a proven record of competence and non-corruption. With an administration with a record of corruption and incompetence, it would be a complete dereliction of their responsibility if Congress had passed that $700 billion bill. And they didn't in the form. And that took a couple of weeks. And then Congress, an interesting thing is that Congress insisted that they put in this provision that allowed them to deal with the mortgages, and I'll come to that in a second, and allow them to have equity injections, putting capital into the banks. Paulson didn't want that. Now it's the thing that he's talking about, and it's the thing that markets are responding positively to. One of the interesting things about modern media is that it allows you to see very graphically what a person says and how he changes his mind very quickly. About 2 weeks ago, he was making these speeches and saying equity injections the thing was an approach of failure. We believe in success. What he meant by that, I'm not quite sure. But he's now abandoned success and gone to failure. Let me say what I think should have been done, and it corresponds to some extent to what the UK is doing and that we are belatedly doing in part, but there are several things that are left out, and it's basically a 5-point plan. The first is something that he tried to not face up to. The banks make some very bad loans and very bad bets, and the result of that is that there were losses. And when you had losses, and you make really big losses, there are holes in your balance sheet. Now, the losses would have been a lot worse, but for the help from Europe, and we are very thankful that Europe, I don't know what you had a discussion before, but the whole American financial system was based on the premise that a fool was born every minute, and we would find those fools wherever they were in the world. That was what globalization did, and we found a lot of them in Europe, and they bought about half of our toxic mortgages. So just imagine how bad our problem is today if we had all those toxic mortgages here at home. Globalization has really helped us. that's created a hole in the balance sheet. If you don't have any equity in your bank or in your impaired equity, you can't lend. The question is, how much equity do they need? The answer is, we don't know. The reason is, 10 years ago, American people like Rubin were talking about lack of transparency in East Asia. Well, these guys invented lack of transparency at a level that no one could ever have conceived of. They are so non-transparent that banks themselves don't know what their balance sheets look like. And the regulators don't know, and the banks don't know what other banks' balance sheet are, and that's why they don't lend to each other, and that's why the credit system is frozen. So when you ask how much equity do they need, the answer is we don't really know. And there is no way that we can actually easily find out. It actually has very strong reminiscences of there's a deja vu for me, of the East Asia crisis. The reason, in part, we don't know, look at any particular bank. Any particular bank is owed money by other banks. Owed money directly or owed money through credit default swaps, insurance policies that they bought from other banks. The problem, just to give you one example, Morgan Stanley, a lot of people wrote, not Morgan Stanley, a lot of people wrote insurance policies, credit default swaps on Lehman Brothers before they went bankrupt. Just on last Friday, there was an auction to figure out what the value, what they had to owe on those bonds. So they insured the bonds, and they have to pay the difference between the face value of the bond, $1, and what the bonds were worth in the market. And the market valued them at the auction, I think, at 12 cents.
10 cents.
What?
10 cents.
10 cents. So they have to pay 90 cents. Now the point is, no one knows who owns these. Maybe you do by now. I don't.
Not sure.
Nobody knows who owns these. So nobody knows who owes how much to fulfill these contracts.
People who owe it know.
The people who owe it know, but and we suspect, this is the point, we suspect that some people may wind up in bankruptcy. We don't know. But now, the point is, if you were owed money and the person who owes you money goes into bankruptcy, then it becomes your problem. And you thought you were in a good position, but then you turn out not to be. And in Korea, this was one of the things that contributed to the Korean crisis. They thought they had insurance on some of the risks, but the insurance companies went bankrupt. So there is an inherent intractability of knowing what your real balance sheet is, because you don't know what anybody else. You have to solve the whole equation simultaneously, and that's too hard. So at least in the and we don't know, to put another point we'll come to in a second. We don't know how much real estate prices are going to go down. We know that we had a bubble. We know they've probably gone down about halfway towards equilibrium. That's at least most experts think. But they could overshoot. And typically in these situations, they do overshoot. So no one can really know what a value of a mortgage is, package of mortgages, because you don't know how many people are going to go are going to default. All that means is we don't know how much capital a bank needs. Now, that means the whole framework of that the Bush administration keeps talking about, this has to be voluntary. No, it shouldn't be voluntary. These guys cannot meet their regulatory requirements in most of the cases with a reasonable degree of confidence. A 99% degree of confidence, which is what you want from a bank. If you put money in a bank, you want to be able to get it back. So they can't meet the regulatory requirements, I think, with a reasonable degree of confidence, and therefore they're bankrupt from the point of view of a bank. And therefore they should be they have to get more capital. It's not a question of voluntary, they have to do it. And they can do it privately by getting capital from private sector, but I wouldn't put any money in most of these banks because we don't know how much they owe, and no one else is. That's why the credit markets are frozen. So that, no one else is willing to lend to these banks, so who do they turn to? They think they found a sucker, the American taxpayer. And that's who they've come to. So the answer, and what Paulson really would like is for us to give them the capital and just say, thank you, you've done a wonderful job for the last 10 years in financial markets, running our economy, allocating capital, managing risk. We want you to go ahead and do it. In the future, we won't interfere with your business model because it's worked so wonderfully. So the last 5 years, you've shown your competence. Here's $700 billion, play with it. I think that's unacceptable. I think anybody with that proven sort of record, anybody who gives money to these people with that kind of record needs their head examined. But we don't have much choice as part of the problem. They have a gun at our head, and they say if you don't, the whole system's going to collapse. So what do we do? The reasonable way to do it, if we could, is the Scandinavian way. Norway, Sweden, very relatively quick recovery. They nationalized the banks and then privatized them. The current system of partial nationalization, as it's called, is rife with conflicts of interest. Are they serving the public or are they serving their shareholders? I think the system is fraught, but even worse, a lot of people don't even want the government to have voting shares. If we're going to be putting in this much capital, I think we have to have at least some voice in some form. Now, it may not be, I don't think we want to go into every detail of management, but that's what people who seeks in the board are for, oversight, general oversight of what they're doing. So one of the things are these equity injections. The second thing is, these equity injections are giving a huge gift to bondholders. Bonds of these banks are discounted deeply because there's a high probability of default. Why should we, the taxpayer, give a big gift? Some estimates are that if we, the effect of the equity injection will be a gift to the bondholders of some $300 billion. So they need to take a haircut by compulsory debt equity swaps or a variety of other ways, but they have to participate in some way. And again, it shouldn't be voluntary. These banks are bankrupt. And if we have adequate regulatory standards, and if there are a few that can prove that they can meet those capital adequacy standards, that they don't have any, that they can get rid of their toxic mortgages, they can get rid of on their own their derivatives and clean up their position, that's fine. But I haven't seen any so far that have come forward. Okay, so that's the first recapitalization of the banks. The second thing that we need to do is we've given the patient a massive blood transfusion and he's hemorrhaging badly internally. And we're not doing anything about the internal hemorrhaging. We're doing very little. And that's the mortgage, the defaults on the mortgages. 12 million mortgages have value of the property is less than the value of the mortgage. Not all of these are going into default, but 3 million have gone into default. Probably 2 million are expected to go into default. But those numbers may be conservative. And the prices haven't fully come down. So we have to do something about the foreclosure problem. And there are several things that we can do. Just to give you one example, we subsidize the cost of housing for rich people by 50%, tax deductibility of interest and real estate taxes. But we don't help poor people at all. It's a reflection of our value system. The rich need help because they need big houses to live. And the poor are used to living in poor conditions. So it seems to me that it would be both help the restructure, help the underlying problem, but also contribution equity, convert the tax credit, a tax deduction into a tax credit. We need bankruptcy reform. The bankruptcy reform that we had a couple years ago made it more difficult to restructure a mortgage than restructure a yacht. It was anti-family staying in their homes. We need what I call a homeowners Chapter 11. That Chapter 11 allows corporations to restructure their debt so they can continue working, so they don't have to fire workers. We ought to have at least the same thing for homeowners, that they can stay in their homes, aren't thrown out in the streets, and the banks made bad loans, and these loans should be restructured. Third thing, the government can borrow at lower interest rates, and it can pass on the advantage of that lower interest rate to homeowners. And there are a variety of proposals of how to do that. So that's the foreclosure initiative. Third, there's a problem of credit, and the only way to respond to that is guarantees. Many countries have already guaranteed their deposits completely. The argument against guaranteeing deposits that some people have put forward is that it creates moral hazard, that you want us to, we want people who put money in the bank to be responsible depositors and make sure the bank is a good bank. Well, if the banks don't know their own balance sheet, with their, and the regulators with their all their accountants, how can we as individuals figure out what a bank's balance sheet is? It's the most absurd idea I've heard in a long time, in a world of a lot of absurd ideas. So why limit it to $250,000? What you're doing is encouraging a run on the banking system. Anybody can take their money and put it in T-bills today. Relatively easy. Why do we want to encourage people to take their money out and put it in a guaranteed money market fund? The government has now guaranteed these money market funds. So, and the other thing that Denmark and a few other countries have guaranteed interbank lending. And I think one needs to free up that kind of lending. I think it is wrong what the Federal Reserve is doing. No one created the Federal Reserve to make loans to General Motors, GE, and other big corporations, but that's what they're out to do. That, I think, they don't know how to do risk assessment. They don't know, they're just going into uncharted territory. That's not the function of the Federal Reserve. Now, the fourth thing is the real economy. As I mentioned, the real economy is suffering. That's what the whole Bush administration is based on trickle-down economics. Throw enough money, $700 billion, at Wall Street, and maybe a little bit will trickle down to ordinary Americans. Maybe. Well, it seems to me we ought to try trickle-up economics. If you give enough money to ordinary Americans, the economy will be stronger, and maybe the banks will get a little bit stronger. That's called trickle-up economics. Wall Street will benefit. But why don't we begin where people are really hurting? Foreclosure, helping people stay in their homes, would do that. So we need a strong stimulus package. Unemployment insurance is about to run out for 700,000 Americans. So there are 700,000 Americans who will have no unemployment insurance in the next week or two. The Bush administration has threatened a veto against any extension of unemployment insurance. Now, maybe they're having second thoughts as the elections get a little closer and the people are in the streets. But it's still, we need more unemployment insurance, and they need health insurance because when they lose their job, they lose their health insurance. States and localities have a $50 billion gap in their budget, and they're going to have to cut back their expenditures. So this is not a stimulus. That's not a right word for it. It's preventing a downturn from getting worse. It's preventing a downturn. Next year, the gap will be $100 billion in state and localities. That's a big negative stimulus. So those are all kinds of things that we need to do to keep the economy from getting worse, let alone to make it stronger. Finally, the main thing that everybody talks about is confidence. I think both the financial markets and the administration have worked very hard to make sure that we have no confidence in them. I don't think they could have done a much better job. And the only thing that will restore confidence, I think, is getting a new administration in Washington. But in the meanwhile, there are a couple of things. I think to restore confidence in the financial markets, you won't restore confidence having the same deregulatory mantra, the same regulators who didn't believe in regulation, and the same guys running the banks with the same regulations, giving them more money to play with, is no reason why there should be confidence. So a lot of people said, they used the little metaphor, they said, well, you know, we have a leaky boat. We first have to fix the holes in the boat before we do the more structural reform of dealing with the regulations and the regulatory structure. Well, my answer is that these guys have shown that the boat has a drunken pilot and bad steerage mechanism, and if we let them get into the boat, even after the patch, they're going to go on another rocky shoal before they get to port. And so if we're going to restore confidence, we have to impose the strong regulation on the banks. We can't fill out the full details now, but now is the time for a strong commitment to do that and an outline of that. Before we give them, you know, after $300 billion, there's supposed to be a congressional, Congress has the vote, the right to stop the next part of the injection. And before they do that, because once they get their money, they're going to be uninterested in that. And finally, let me just say one word about, a lot of word about this is going to be a good investment, you're going to get a return on it. It's very interesting. It's the first time from Wall Street that they've ever said that spending might have a return on it. When we were spending on infrastructure, when we were spending on human capital, when we were spending on any other thing, they never talked about the return on that investment. They just focused on the deficit, not on the returns, the fact that our economy was going to grow faster and there's going to be a social return. Well, this is the first time that spending seems to be a good thing. And you can figure out why. But if they were so confident that there was going to be a positive return, why was there such resistance to saying, if there is a hole, if there is a loss, the financial sector should pick up whatever that loss is? If they were so confident, the way they could have shown that confidence is when they went to us and asked for $700 billion, they'll say, you're going to get repaid, and to show our confidence that we're going to get repaid, we will pay by a tax on our sector for any dime that is lost. I haven't heard that from anybody in the financial sector so far.
Okay. Thank you, Joe. Richard?
I first want to say that in the New York Times on Friday, there was an op-ed piece by a professor at University of Chicago who said what we ought to do is kill all the banks and let the marketplace sort it out, and so what if people have to postpone their investment decisions for 9 months because the banks will all come back to the profit motive in 9 months' time. Although he has no idea whether it's 9 months or 9 years or longer. It was just utterly reckless drivel. And at the same time, when we had this defective TARP come out the first time around, I saw Joe on TV giving very sober and thoughtful recommendations about how, instead of some massive reverse auction that would let the government be picked off right and left, that we should recapitalize the banks. And Ned Phelps wrote a piece in the FT in the Wall Street Journal along the same line, so I think we should be very pleased at Columbia that we're giving good advice while other places are not. However, I do have a few points. Okay, the tax that the private sector, okay, what's going to happen to the banks that truly are bankrupt, that don't have the capital to support their business? Take your pick, the ones that are left. National City, Key Corp, Chorus Bank, Downey Financial. those banks are going to be taken over involuntarily by the FDIC, and deposit insurance rates are going to go up. The tax is going to double next year. So it's pretty much involuntary, and there'll be a tax to support it, as you say. And, let's say Wells needs $20 billion to keep itself going. It will raise $10 billion maybe in a rights offering, and $10 billion in pref shares from the government. I think it's a very healthy thing, and to make that voluntary will end up serving the purposes of putting them on a firmer footing. And yes, I think the government will probably come out just fine from that. I'll say it. I think guaranteeing interbank deposits, it's basically already done. I think the Fed has signaled that. I think if they made it explicit, you'd see a run on CIT and GE Capital and Ford Motor Credit, the ones that were cut out from the guarantee scheme here in the U.S. I don't know that's explicitly necessary, because I think it's pretty much there. And I think this revised TARP, which maybe you and Ned had a role in promoting, I think it will ease the money markets. As you know, LIBOR is set at 6 a.m., and it was set this morning before there was a chance to fully digest the new era of good feelings that were ushered in today. So maybe tomorrow morning, we'll see that. I don't think it's completely fair to blame the U.S. for imposing this on the rest of the world. Just last week, the first structured investment vehicle called Sigma Finance that was operated by Gordian Knot. That was invented in the UK, and it's finally out of business. It was a bad thing that they wrought on the world, and we took that we imported that from Europe. And I guess finally, we haven't yet had an official quarter of negative growth. The first 2 quarters were positive. I agree that the third quarter is not looking very rosy, but there have been times where asset prices decline, stock market prices, housing prices, and as in '87, the response is an increase in labor supply, a reduction in real wages, but an increase in output. I mean, it might not be a Keynesian type reaction. Time will tell.
But there's 1 million losses in the private sector jobs this year. So,
yeah.
Output and employment are going not the same way.
I agree. I won't deny it. But I think one could still be hopeful that this could be a shallow sort of thing. Well, I don't want to use up all our time.
Yeah. I don't have much to say. I mean, I think we've been talking about that. Sorry,
can I ask you, ask you to refer also to emerging markets? Since
absolutely. I was going to say that. Just because, I mean, in terms of the length of the recession and the severity of the recession, I'm hopeful that emerging markets will continue to provide a very strong engine of growth in the world. I mean, I was saying before that the world is becoming, in my view, much more multipolar than it used to be. So emerging markets now represent about 35% of the world economy. I mean, the IMF was saying that growth for 2009 in emerging markets will probably be in excess of 6%. It's contrary to the past, much less dependent on exports. Obviously, a severe recession in the U.S. will cause emerging markets to some suffering. But I think that resiliency within emerging markets is much stronger than it used to be. Export is important, but domestic demand growth and investment is much more important than it used to be for the self-sustainability of growth within emerging markets. And I think that one of the reasons why the U.S. has not been in recession as up to now is really linked to the strength of demand coming from emerging markets, from the rest of Europe also, but largely from the emerging world. And when you read the quarterly results of most corporate bellwethers in the U.S., whether it's Coca-Cola, whether it's GE, whether it's Caterpillar, it's really driven. Their sales and their profits are driven by emerging markets. So I think that the resiliency of emerging markets will continue to provide an engine of growth and will probably have provide more stability to the world and less volatility in growth. I mean, in terms of what you were saying and solutions for the current crisis, I'm very sorry, but I think I agree with most of what you were saying. I mean, what we've been saying at the beginning of this debate is really that it is a market failure. And that the government stepping in as some kind of lender of last resort and ensuring the credit worthiness of systemically important institutions is absolutely key to restoring confidence, to restoring a sense of credit worthiness in the interbank market, in the money markets, and in the financial system as a whole. So I think it's clearly a market failure that has to be addressed through better regulation and through various things. So I think a lot of pain has already been taken by a lot of shareholders of the banks and a lot of people with a stake through either job losses or just pure losses on their 401ks or their retirement accounts with those losses. So maybe, I don't know, a different type of arrangement can be thought of. But I think a lot of pain has already been taken. Whether we have to punish the bondholders now, I'm not sure it makes a lot of sense with the need to resume stronger interbank lending, because if you punish the bondholders, why not also punish the banks that will benefit from lending in the short term to other banks? So I don't know. I think at some point a line has to be drawn in the sand, and what the UK has been doing, I think, makes a lot of sense and really fights the issue at the heart of the issue, which is creditworthiness and confidence in the system.
Yeah, if I may say, I find paradoxical, your point about emerging market, because some of the largest collapses in the past weeks have been in emerging markets. Indonesia. Yeah, Brazil, which is full of international reserves, has been severely hit by this situation. All of Latin America, Mexico is the temple of rectitude in macroeconomic policy, according to orthodox analysis. Also very severely hit. So this issue that emerging markets, will support. The growth rate of emerging markets is largely determined by, to a large extent by China. Maybe China, I would say, can support its own growth, but is it going to be an engine of growth for the rest of the world? I think it's an open question. Whether we have come to the stage in which emerging markets can really become engines. In the short term, we have seen the opposite. They seem to rather be desperately looking for their own solution, and they have experienced some collapse. But going back to one of my questions, I think going forward, I see actually a surprising degree of agreement. But I come back to my question regarding credit. Is credit going to be sufficient to support growth in the U.S. or the world economy? I see, from my experience of looking at emerging market crisis, after a crisis, the credit system just stops being functional to the economy, and the only way to go is actually, as Joe was saying, in some support to the real economy. That is fiscal policy. Perhaps we're going, we have a very peculiar sort of monetary trap that we see in all crises, in that just monetary policy simply doesn't work to reactivate economies after the collapse of the financial system. And the only way is fiscal policy. Just going second round, Joe.
In a way, that's exactly the kind of result that's predicted by the kind of models that Bruce Greenwald and I formulated on theories of credit, supply of credit. So it is both, as you say, I think, an accurate description of what has happened historically. It happened in the United States, for instance, after the 91 reset, the S&L bailout. One of the things was that not only did the balance sheets get eroded in that, but the credit standards, after they realized that it got very strongly tightened. And one of the things that happened in '93 when Clinton became the president, two things happened. There was a recapitalization of the banks in a very surreptitious way. What had happened was the banks had bought a lot of long-term bonds because of a regulatory mistake that Greenspan had made. Most of his mistakes have been of disastrous consequences, but this was a mistake that was a positive consequence because what he did is he had said that he ignored the importance of interest rate risk. So he said long-term bonds will be treated as if they were safe. So banks went into long-term bonds that were then offering a very high return, even though, and the reason they were offering a high return is there was a lot of interest rate risk. So they went into that. Was one of the reasons why credit was restrained. But that meant that they had a lot of long-term bonds in their portfolio. When the long-term interest rates fell, the value of the bonds increased, and that was part of the recapitalization of the banks. But the other thing that we did very explicitly in the Clinton administration is we lowered, we tried to lower the regulatory standards in a, you might say, in a temporary forbearance way to try to encourage lending. Or at least at that point, actually, we thought they had gone excessively tight in response to the previous episode. So that is likely to happen again. There are a couple of things that leave me a little bit more hopeful this time. Let me just mention them. One of the things that is supposed to happen as part of the equity injection of that part of and of the TARP in general, the bill, is that the government is supposed to be able to impose conditions on the banks that accept this money. And one of the conditions that members of Congress intended or hope is that they would continue a certain amount of small business lending. That was sort of part of the quid pro quo. If they don't do that, that will be viewed as a failure, and so that's one of the things that's going to be monitored in response to this. The second is that we've taken over Fannie Mae, the largest mortgage provider, and so we own, and so there is a recognition of the need to continue supplying finance to the mortgage market. But I think it finally raises the question, there are other arrangements for providing credit that some people have begun to talk about. George Soros has been advocating the Danish mortgage bond market, and that is a way of providing credit to the mortgage market that avoids the use of banks and therefore is not dependent on the capital of the banks.
Okay. Richard, Christian, do you want to make?
I just wanted to say something about the emerging market crisis. It's not directly related to what Joe was saying, but I think emerging markets have been pretty resilient, even from a market point of view. If you look at what happened in stock markets and in bond markets until a couple of weeks ago, they have gone pretty much in line with the rest of the markets. A little bit more underperformance, I would say, but after many years of very significant outperformance. What we've seen in the last couple of weeks in Brazil and in other countries, in Russia, is really another market failure. The fact that there was absolutely no liquidity whatsoever in any of these markets. So we've seen the real go from 2 to 2.4 and now back again to 2.1 or 2.15, where very close tonight. I think not because of a fundamental lack of confidence in the country, but just because there was no buyer whatsoever. I mean, the markets were totally frozen. So any type of forced selling was provoking this type of market movement. And I really don't think it's symptomatic of what has been going on and what, in my view, will continue to go on, which is a relative better performance from emerging markets than the developed markets.
I think our mortgage market, with or without the agencies, is very effective in principle at providing home loans to individuals through securitization. There's no better way of taking banks out of the picture and passing that risk on to end investors. I mean, there's no question that it went astray, but I think throwing out that model, which works in the UK, it works in Australia, it works in the Netherlands, it was starting to work in the Baltic countries, and it's working in Mexico now, in Canada. I have confidence it will come back better and stronger. On emerging markets, I have one insight. I don't know if we count Iceland as an emerging market, but it is now if it wasn't a week ago. One leading indicator I had is about 2 or 3 students in my class every semester came from Iceland in international capital markets and advanced structured credit. So you makes you wonder, how come they need to how come there's so much interest in capital markets that they're sending 3% of their country here to learn all about it? Maybe it's a country with more financial engineering per capita than it probably required. It might be a good leading indicator of a place that's about to collapse.
Okay, we'll move now to a question, but before that, and to finish the recording, let's give an applause to the panelists.